Hello and welcome to the UBP podcast. My name is Peter Kinsella and I'm the Global Head of FX Strategy at UBP. Today, I'm going to talk about the global currency market and the forthcoming US presidential election. US presidential elections are momentous occasions. They entail a transfer of power and the imposition of new political and economic regimes in the world's largest superpower. As a result of this, what happens in presidential elections matters, and it matters a lot for currency markets. It's worth taking a little bit of altitude and reviewing how currency markets fared under the Trump presidency. Broadly speaking, the dollar rallied during the course of Trump's term in office. Equity markets also boomed for a variety of reasons. So in a sense, Trump was a strong dollar and a strong equity president. During the early stages of the COVID-19 pandemic, the US Federal Reserve cut rates back to all-time lows of around 0 to 0.25%, and it restarted its quantitative easing program. As a result of this, the dollar has weakened on a trade-weighted basis by around 9% since March. Coming into the final stages of the election campaign, the dollar has continued to weaken modestly against most of the major currencies. Euro-dollar rose from levels of around 117 to current levels of around 118.50, and dollar-yen has fallen from levels of around 106 to current levels just below 105. Even the beleaguered British pound has fared well against the dollar, moving from levels of around 127 1 month ago to current levels above 131. Here at UBP, we think that this is only the beginning of a broader trend of dollar weakness. Historically, the dollar tends to weaken following global recessions, and price action since the beginning of May has been consistent with this long-term behaviour. What really concerns us is the development of the US budget and current account deficits. The budget deficit is currently printing at levels of around 13% of GDP, and this is unlikely to contract in a meaningful manner in 2021. Heavier borrowing requirements will lead to an aggressive widening in the current account deficit, which already prints at levels in excess of 3% of GDP. And when the current account deficit widens in a sudden manner, it does tend to lead to material dollar weakness. This trend will be exacerbated by the US net national savings rate, which is already at the incredibly low and negative level of -1% of GDP. The dollar still trades at elevated levels according to most valuation metrics, meaning that the recent bout of dollar weakness is merely a taste of things to come. The question then is what happens to the dollar and how it and other currencies will trade under either a Biden or a Trump administration. In recent weeks, the dollar has weakened modestly, which we think indicates that markets are starting to price in a Biden victory. What has not been priced in is a possibility of a so-called blue wave, in which the Democrats take control of both houses of Congress. If Biden does secure the presidency and the Democrats take control of both chambers of Congress, it will lead to currencies with a high beta to global growth outperforming, due to the Democrats' plans for large-scale infrastructure spending. The likes of the Australian dollar and the Swedish krona will do well in this situation. The Australian dollar indeed will benefit from higher commodity prices as the Australian terms of trade improve due to higher export quantities and higher prices. The Swedish krona will do well because of Sweden's status as a small open industrial economy. If the US enacts aggressive fiscal stimulus measures, it will benefit as the markets price in a more aggressive recovery in the manufacturing and industrial sector. It is worth highlighting that a definitive election result is unlikely to be forthcoming on the night of the election itself. This is because of the huge quantity of postal votes, which may delay the announcement of the election winner. If this period of uncertainty is prolonged, for whatever reason, risky assets may decline and the dollar may appreciate, albeit modestly, as investors opt to maintain cash balances rather than to invest in risky assets. However, once clarity is found, the dollar should weaken on a more sustained basis. In the event of a Trump victory, which is now seen with only a 30% probability according to betting markets, we think that higher beta currencies will struggle to appreciate. Emerging market currencies may weaken because markets will anticipate that Trump will take a more aggressive stance with China during his second term. Safe haven currencies may rally initially, and in the context of ongoing dollar weakness, dollar-yen may decline to levels of around 103. Geopolitical concerns will increase significantly if Trump wins a second term. Biden is unlikely to take a vastly different stance regarding China, but investors may hope for a reset in US-China relations under a Biden presidency. These hopes are likely to be dashed. Coming into 2021, we believe that the perfect hedge for the current combination of economic and political events is to maintain long gold positions. Because gold is highly correlated to the dollar, any significant dollar weakening will result in increasing gold prices. Additionally, if the situation in the South China Sea or regarding Taiwan continues to deteriorate, this may lead to heightened fears of conflict, and gold will of course outperform in this scenario. In summary, we anticipate that the dollar will weaken on a sustained basis, irrespective of whoever is president. If Biden wins, currencies with a high beta to global growth, like the Australian dollar and the Swedish krona, should do well, reflecting expectations of increased infrastructure spending. If Trump wins, dollar yen is likely to decline, and emerging market currencies may fare badly, initially at least. Elevated geopolitical concerns mean that gold should continue to trade well, and we believe that gold should be considered as a core holding in any investment portfolios over the coming years. Thanks for listening.